All right. Welcome to the Big Skinny with me, Basenese, where we give you all filling, zero fluff, or as some people have referred to it, the sports center of financial news, because we give you the highlights that matter in the markets, nothing else, no noise, and we do it in a straightforward format. One headline that you should probably ignore, one chart that contains the key data you should follow, and one investment insight that leads you to the promised land, the touchdown, the way you make money in this market. Because let's be honest, we can have fun together, but if we're not making money together with these insights, there's no purpose to it all. All along the way, we also want your feedback, questions, comments, biting criticisms. We're live streaming on multiple platforms, both X, LinkedIn, and YouTube, so don't be shy. Let's go, Dave. 12601. I think you got your countdown wrong there, but we'll go for it. Join the Big Skinny live on socials while we break apart the latest news in the markets. In this episode, we have a special guest, the COO of Public.com, that is reimagining how a brokerage account should function right at the right time using AI and leveraging just the retail revolution that we've been talking about. Looking forward to talking to Stephen Sikes about what they've got going on, the latest developments there. We're also bringing back our top 10 AI stocks not named Nvidia list. We're going to focus on part one and update you on 5 of the 10 this week. Remember, this is a list we released in June that's crushing the markets, and we'll get into that. Well, almost all of them are crushing the markets. We champion our winners and admit to our losers, too. We'll do that today and tell you the names that still could be bought up in this market. And then finally, we round out our episodes with our segment called Headlines and Head Scratchers, where we bring you data and headlines that you might want to think twice about or follow. I'm joined by my partner in crime, Dodd, during that segment. But before we get to that, we got to get to this week's rundown. We're talking about all things NVIDIA and AI. So let's get to it. All right, in this week's rundown, we're talking about the only thing that apparently mattered to anyone last week and this week, and that's the NVIDIA earnings report. Every quarter, it becomes the most important day for the bull market, apparently. Insert melodrama. It's not really true, but Axios running with this headline that is completely wrong. The market is just one stock now. Cry, cry. It's actually 500 in the S&P 500 and about 3,500 on the publicly traded market large cap exchanges. But what's the whining and whinging about, you might ask? Well, apparently the performance of the S&P 500 since, I don't know, early October has been mirrored very closely just by Nvidia. So the suggestion here is as Nvidia goes, so goes the rest of the market, which kind of makes sense if you consider the huge weighting that Nvidia has in the S&P 500. But folks, look at the time period here. It's not even the beginning of October. I mean, gosh, we're not even looking at 2, 3, 4 months of performance or year-to-date performance. I think that's a little bit embellished here. But, some people believe Axios. We got one in particular here, Marta Norton, not to pick on you, but you went vocal with it in this article. So you think it's a one-bet market, and that, to me, is risky. Well, I'd agree with you. It is risky if it was a one-bet market, but I don't believe it is. And I'm not alone. You've got others out there, like our buddy Chris Camillo, who joined us on our humanoid robot episode, saying, look, understand the situation, folks. The U.S. is making a huge bet. They're being risk takers in terms of building the infrastructure for AI. Wait for the payout. So what do we do? Well, Chris is right. I agree with him because everyone's focused on this runaway construction spending on data centers. Look at the timeline. Since ChatGPT was released, that kicked off this AI boom. You've seen a massive surge in data center investing, over $40 billion based on the last tally. And everyone's afraid that we're building out the next big boom prematurely, and they think it's taking up too much of our GDP. But newsflash, here's the context. Always look at the data that matters. This current AI boom pales in comparison to past technological revolutions. Think railroads. Yep, I went there all the way back to the 1800s. Think the auto infrastructure, good old Henry Ford, right? 2.2% for the electric motor. Tech hardware, we're only at 0.8% for generative AI. So we could, by historical standards, more than double from here and still not be in bubble territory. So what do we do? What do we take away from all of this? Well, that's where our money chart comes in this week and every week that guides us to show this is not a one-hit market like Milli Vanilli. Blame it on the rain and blame it on the headlines, folks. We have 37%. That's right, count it, 37% of the 500 stocks in the S&P 500 outperforming the market this year. It's not just little old or big old Nvidia that's outperforming. There's dozens, literally, of other companies that could be great investments. So spin up the tune, one whiskey, one bourbon. What is it? One whiskey, one bourbon, one scotch, one beer. There it is. We got one problem, one stock, and 1 year here is actually outperforming. So what's the investment to take? If you're worried about Nvidia, don't buy Nvidia. Buy an equal weight ETF that doesn't have the bias so much towards Nvidia. Don't buy the S&P 500, the SPY ETF. So that's a simple solution. If you think it's a one risk market, I got news for you. I don't think it's that high of a risk just to buy Nvidia. The company came out and reported quarterly results, a $4.5 trillion company that reported over 60% revenue growth, over 60% sales growth, and even better, said next quarter's going to be even faster than that. So folks, that's not the sign of a bubble. That's the sign of a trend ramping up and accelerating. Don't bet against it. Happy short week, Vanessa Michelle. Happy short week to you too. I am thankful for maybe some rest and relaxation and turkey overdose and overload on Thursday. But we're glad you're joining us here. Alex from Los Angeles in the house, buying the dips on IREN, making thousands, man, printing money. Look, we're going to talk about IREN later in this episode, so appreciate you joining the conversation. Please, if you've got questions about any of our top 10 AI stocks, about the market, about the Fed, about Treasury Secretary Scott Bessent, or anything else, even the Dodd man's musical choices, let us know. Don't be afraid to opine. And we're also going to ask you, don't be afraid to subscribe to our YouTube channel so you don't miss out on an episode ever. We also post key interviews here too, so you'll be seeing them along the way. So yeah, be like Mr. Beast. Help us be a fraction as successful as Mr. Beast, and follow us on YouTube before the night is out. Before the night's out, we're going to be right back after a quick break.
First of all, we haven't given a penny yet. And all of the revenues that we're projecting for next quarter and for next year, it's just, if you just think about the level of investment that we would make in each tranche, and none of it is forecasted at the moment in the $500 billion that I'm talking about. The investments that we're making is a tiny percentage of our overall revenues. They have to go raise the vast majority of the funding that they need. It's raising through equity, through other investors, and of course, every single round has been oversubscribed for OpenAI and for Anthropic and for XAI. They've been all oversubscribed, so they certainly don't need our investment.
So is the bubble, Stuart, in OpenAI. And all of the money that OpenAI is spending. OpenAI is not publicly traded, as you know. However, you've got to watch out for that, because OpenAI does not make money. It is not profitable right now.
Yeah. What do you think, Lou?
Listen, I think Nvidia got nominated to take the polygraph test for the AI bubble, and they passed with flying colors. They did. There's absolutely no bluffing going on. I mean, this is a $4.5 trillion company, growing earnings and revenues by more than 60%. The demand is real, as he revealed to you in your exclusive interviews. And I think what's important, you bring up OpenAI. We're going to get some transparency there, because there are plans for an IPO possibly next year. So in that S1 filing, we'll see where their revenue really comes from. Here's what I would say. OpenAI is going to have pricing power. I've been an early adopter of ChatGPT and upgraded to the Pro subscription from 10x price change, right? From $20 a month to $200. It's well worth it. So OpenAI is going to be able to, I think they'll have pricing power, but again, financing is key. Jensen brought it up. We're not coming out of pocket. They have to raise that in the capital market. So right now, I don't see any concerns, but I think you're smart to say, hey, down the road, we got to figure out where's all the money going to come from. Welcome back to the Big Skinny, where we're breaking down our top 10 AI stocks not named Nvidia. For those of you who are new to our program, I believe it was on June 2nd, where we unveiled a list of 10 AI stocks you should be buying in this market. And this list included names like Teradyne, Samsara, Astera Labs, Inodata. The list goes on, and we're going to review them today with my partner in crime, Mr. Dodd. So let's bring him in while we got him. Hey, man, what's going down?
What's up, brother? Feeling a little under the weather today, so if I'm a little scratchy or groggy, man, I apologize.
You got a deep voice.
Or I'm just talking deep for you tonight.
I'm just going to leave that comment right there, man. We were talking about these top 10 AI stocks, and I wanted to bring up how the performance looked. I don't know, a couple weeks ago before the market cratered on us, and you put together this nice handy chart for us, and the average gain, an eye-popping 50%. I mean, if we didn't have that oddity at the bottom there, no pun, pun totally intended, down 44%, we'd be closer to 60%. So not bad performance. What do you think?
Come on, that's a high five. Come on, that's a high five.
That is a high five. I agree with you, man. High fives going all around. But then look, we got to face reality. These stocks have pulled back dramatically, which is why we're having this episode focusing on them again. But still, pretty solid results here. Average gain of about 30%. Oddity is just in the basement and headed lower, if we can believe it or not. And that's going to lead us to make some portfolio changes here tonight. But again, I want to focus on, look at these names, not a single mention of Nvidia, but we've got 5 of them up more than or right around 50%. That's pretty good. I'll take it for all those people whining that this is a one stock market.
And these numbers were from Friday, Lou. So today, there's a nice pickup today. So I think overall we're up another, about another 6% just today alone.
All right, so let's cut to the chase. We're going to cut loose on a couple stocks because people are really worried about revenue from AI products and services. And here's what I think is interesting about our list. We're not betting on the future. We're betting on companies, for the large part, that already are generating revenue from AI products and services, or their existing businesses that they're pivoting to AI that are only growing faster because of their inclusion of AI. But nevertheless, there are always losers in a portfolio, and we don't want a big mistake to turn into an even bigger one. So let's cut bait and move on from 2 names today. Oddity, get it out of here. It's down 50%. This was one of the more strange companies in our portfolio that used AI to help develop personal consumer brands, including makeups. Dodd knows a lot about that. Healthcare products, nutraceuticals. It just didn't work out, man. What's the next one on our list that we're cutting?
Core Scientific, which was up a second ago. So yeah, Core Scientific is the next one that we're cutting.
Yeah, this is one is going to surprise some people because we talked about it early on in terms of the AI data center boom, where they were a Bitcoin miner that pivoted to the AI data center boom. But I just think they got caught up in the CoreWeave debacle. Remember, they were supposed to merge with CoreWeave. That deal got voted down. Then there were some delays announced by CoreWeave, which really brought the whole market down. That's what tumbled the AI trade a couple weeks ago, was disappointing guidance and delays from CoreWeave. And lo and behold, those delays stemmed a little bit from Core Scientific. So I think this is a great company.
That's the rumors that I heard that was Core Scientific that was the delay. Is that any facts to that?
I think there's some facts to it, but I think it's not something to worry about. I mean, look, we're not building little quick things here. We're building huge data centers that require tons of infrastructure and coordination. So it's reasonable. If you've ever built a home or built anything, delays are part of the process, right? So whatever you say the timeline is, it's going to get extended. But nevertheless, I think there's more upside in a few other names related to that.
Real quick before you move. Well, you've already moved.
I'm moving. I'm moving, man.
We're moving on to Iran. Screw my question.
No, what's your question, man? The Dodd man speaks. We respond.
I was going to say with Core Scientific because, they're still in the AI energy space, but are we moving them off the list, do you think, because there's just better names out there or because it's fundamentally not still a good investment? So
fundamentally, I think it's still a great investment, but we only got 10 slots in our list and they would move down to 11, right? So it's like,
okay, so that was my point. It's not don't invest in this company. It's just that there's other ones that we feel are a better investment at this time.
Exactly. It's not the case of our Florida Gators and UCF Knights that they're at the bottom of the list, all right? Like they didn't go anywhere. Yeah. Chad Sowers, we still got birthday emojis coming up for you, my friend. We celebrate you all the time you're on the show. ODD bumped today, actually a great position, getting outside of A-buy, but it oils my play. Why do you feel like JPN said sub $50 a barrel today in 2026? Listen, I think JP Morgan, everyone likes to be bold and right if they get it, but everyone forgets about the bold calls, so there's very low risk in it. But I think JP Morgan's wildly off base with their oil calls. We can bring that up later on in the show when we get to the Dodd block. But it is an interesting thing I've been tweeting about, and we'll cover in an upcoming show why in fact, I think JP Morgan and Goldman are wildly off base with their oil price predictions. But getting away from oil, kinda, because when you drill for oil, you get natural gas, and natural gas powers data centers as well as electricity generation, power plants, and that's where IREN fits into the mold. So to your point, Dodd, your question, are there better choices to replace Core Scientific?
Here's one.
Yeah, here's one, right? The next one is TeraWulf. So we've had we had the board of directors from IREN on, Mike Alfred, and the CFO from TeraWulf on. These are two names we're going to add to the portfolio, and let's go through the reasons why. Let's do a quick recap on what's driving the fundamental case for all these companies. Look, it's a U.S. data center boom. I mean, the people watching us, and you, Dodd, have probably seen headline after headline talking about this, right?
Every day, man.
Yeah,
reading it all the time.
It's crazy. Who would have thought this 6 months ago? But you see here, this is just a huge, you don't even have to understand and read the lettering. I mean, it's just a huge increase in terms of U.S. data center construction and planning based upon the gigawatts of capacity. So you got about 80 gigawatts under construction. We need to double or triple this within the next 3 to 4 years to meet AI compute demand. You have the head of Google coming out saying, we don't have enough compute for the next 6 months. This is a huge boom. So anyone that's got inventory, when I say inventory, I mean guaranteed power, like IREN and TeraWulf do, that becomes very attractive just customers for these Big 10 hyperscalers. So you're seeing it happen already, and this market pull down has brought them into really attractive ranges. I know you're a shareholder, right?
Just thinking about the need and looking at the far right there, what's built. I mean, it's like a sliver. There's nothing, so.
I mean, we talk about going back to the future. I'm just pulling up the chart right now. IREN's trading at prices it was at late September. So you're getting to go back 2 months. Nothing's fundamentally changed for the worse for the company. It's actually improved. I would say the same thing for TeraWulf. If you pull up their press releases for either of the companies, they continue to build out and announce new customers. IREN in particular is estimating over $250 million in annual recurring revenue for next year, I believe is the latest tally. That's going up from the latest quarter of 28 million. So you're seeing a 10x increase. They think they could hit 500 million next year. That's a huge boom. That's not reflected in the share price. And TeraWulf year to date, we're getting back to right around the September timeline. So IREN here, you're looking at the chart. You can see this is a nice, significant pullback, a name that I think has to be in a core position of your top 10 AI stocks, not named Nvidia. I own it. You own it. I've been buying more. You've been buying more, I think.
A little bit. Yeah, absolutely. As much as I can. So, but with these two, like as a retail investor, what are things to watch moving forward? Like, catalysts to say that this is still a strong buy and keep staying in it.
Yeah, here I think is the key thing, and Mike Alfred brought it up when we talked to him, and then he brought it up in a recent tweet that he was saying that every gigawatt of capacity is going to be absolutely consumed, right? The demand is absolutely massive. Every single spare and idle megawatt is going to be scooped up. The best teams in sight will get the best deals, but eventually everything will go. There's no bubble. This is still the first inning. So look, the demand is there. You heard Jensen Huang from Nvidia say it on the latest quarterly call that, like, look, they can't sell them fast enough. You just don't have the power to plug them in. So basically anyone that has the power is going to get scooped up. And Mike put his finger on it, and this is why I like IREN and Wolf the most. IREN's vertically integrated. They handle the whole stack, so they can they earn most of the margin, right? Think of it as a subcontractor versus the general contractor, right? That they're doing every part of it, so they're getting a piece of the pile all along the way. TeraWulf, I love that team because they came up in the power industry, right? They're not Bitcoin miners that found a new opportunity. These were guys that purpose-built the portfolio they have to meet the demands that we're seeing right now. So I think beyond securing all the capacity, the next big thing to look at is the rates that they get. How much are they getting in millions of dollars per megawatt? And I think it was JP Morgan actually came out today and increase their base estimate for rates per megawatt. So I think that's going to be an indication of the strength of each team in their portfolio. Chad back at it with a comment on Wolf. He loves that guess. Yeah, Patrick Fleury, interestingly enough, is a good friend of one of my high school buddies. So small world, but a very competent leader and a great communicator. You double down today. A re-rate is in order. Yeah, I think I put it out there publicly. I think the stock should be worth about $25. So TeraWulf going from 12 to 25 is a nice double from current levels that would fit in nicely in that portfolio. So, you know, I think Core Scientific could get into the 20s, but, you know, that's not as impressive as what TeraWulf could do from here.
Makes sense.
So next on the list, buy more. I got a froggy in my throat, man. You might have to take over from here. What would you do if that happened? Samsara.
Dude,
what does Samsara do, Dodd? What do they do, my friend?
The Internet of Things.
Look at you, man, reading the contextual clues in the ticker symbol. This guy's a keeper. He knows what's going on, helping me out. Yeah, that's right. Samsara, they were actually based in the Internet of Things growth trend, which was supposed to be 50 billion connected devices. It was a way to bring the physical into the digital. And look, this trend didn't go anywhere. It's actually out there. It's just now being optimized with AI. So if you look at physical operations, there's over 150 million commercial vehicles, 2 billion frontline workers, and physical things account for over 40% of global GDP. Wouldn't we like information about what all those physical things are doing, like where your fleets are, how they're operating, how fast is that idiot driver going? Is he slamming the brakes? What is going on in the field with heavy mining equipment? Where are opportunities to add value along the way? The only way to do that is to use chips out in the physical world and then have the data communicated and analyzed with AI. And that's exactly what Samsara does. So they have a very strong existing business that continues to grow, and now they're layering on top of that AI to improve their margins. So this is a company that's slightly underperformed for us that relative to the rest of the mix, but I think is still poised to do really well as we move from just the build out of AI into the solutions.
And noted, this one is one of the ones that's down a little bit, but you know, you're still, you know, bullish on it. Like,
yeah, look, sometimes when it's down, you know, look, I'd say it's counterintuitive. Everyone's natural reflex is to buy when things are down, right? It's like, hey, let me average down my cost, down my cost. Right? Yeah, it's on sale. And in this case, I do believe it's on sale. But by the same token, we shouldn't be afraid to buy things that are working out and working well. A great example of that has been Alphabet, which, I don't know, that'd be number 11 on the list, but it's just gotten stretched. But Alphabet, we're banging the table on that. Google at $145 a share in April. Now it's soaring, and we've been buying all the way up. So, yeah, Samsara is a great name. Yeah, broke through $300 per share recently. You know, it's a funny thing in AI. Leadership changes every week in terms of the AI agents, and now Gemini has jumped to the top of the heap in most recent weeks. So now everyone loves Google, even though at the beginning of the year everyone hated Google, and it was the most cheaply traded and undervalued Mag 7 name. Not anymore.
Still loving Google.
I do. I still love Google, and Google loves us because they know everything about us. So there's no way to escape that. I think everyone's argument is that AI is going to get rid of the search engine and the advertising associated with it. And I just disagree. I think these businesses are going to learn how to adapt and leverage the skill sets and the technology advantage they have in the current environment, like Apple will, even if they're slow and behind on their AI agents. I mean, Alphabet, everyone was ridiculing them for being behind. They were never going to make the shift. And now everyone's celebrating them this week for being at the top of the heap. So,
are you changing your fanboy Apple hat for Google hat yet, or you still holding on?
I don't think so, man. My cost basis is too cheap on Apple. It's like split adjusted $40 per share. So still love me some Apple. Apple and Alphabet Apple's a definite ride or die, but Alphabet's coming up quick to be in that portfolio too, where it's the forever portfolio.
You can love more than one. It's okay, man.
No, you can't love more than one, dude. You can't. You're not.
When we're talking about AI,
you're supposed to fall in love with your sweethearts, not your stocks, my friend.
I'm talking about stocks here, Lou. Companies.
All right. So next on the list, we need an update on Inodata, right? This is a company that's like, think of it as the Intel inside of the AI trend, right? Intel always made the chips that went into every desktop and laptop. Inodata is the service provider that handles all the data management for all, you know, practically all of the Mag 7 companies that are levered to this trend. So they're the secret sauce. They've been in the data management business since the beginning of their existence, and they've just continued to increase their revenue. I think in the last quarter, it was north of $70 million in revenue being generated from data intelligence services that they're providing. So the stock had a really nice run this year, and it's kind of pulled back with the rest of the trend. If we can pull it up on the screen too, you'll see that we've had an opportunity here. Yeah, another strong pullback, or in this case, we're getting back to looks like the February, March area where, yeah, you're getting a compelling entry on no fundamental change in the trend or the business for this company. So if you think about it like this, Inodata is leveraging the growth in data. Dodd, do you know offhand how many zeros are behind a zettabyte?
Oh, geez. I'm gonna say 15.
Yeah, I don't know offhand. I think it might be 15. I think you're right. I've forgotten. I know. 15, right? I know it's just a lot. And here's the thing.
It's 15, at least for today's purposes.
If you look, I believe the stat was back in 2010, if you digitized everything in the Library of Congress, it would take up like 2 zettabytes. So think about that. Now we're getting to a point where by 2030, we're going to have over 500 zettabytes. That's insanity.
That is insane.
10 to the 21st power, says our resident historian and mathematician, Dan the Man. So 10 to the 21st. You were kind of close, Dodd. You were closer than me.
Ballpark,
if this were the Price is Right, you win because you went under, not over. So the key point is this. There's a ton of data that's...
Go home.
No, I mean, look at this. How many people have on their phone tens of thousands of photos that they're never going to look at, right? Well, they're stored, curated, copied, wherever, distributed. I mean, it's just growing exponentially. So Inodata's market continues to grow alongside with it, which incidentally, this is a topic for another day, is why cybersecurity is such a big deal too. Because if you think about protecting, cyber warfare versus traditional physical warfare, the landmass never increases in size, right? Like, the boundaries, but now in digital warfare, cyber warfare, it just is ever increasing. Imagine if the continents reshaped themselves in countries every day and grew in size. You could never defend it. So moving on to Tempus AI. This one is, I love this one because its name has nothing to do with really what it's about. It's got a great underlying business. This was an early adopter of genetic testing, oncology testing. So you see here the increase that they're doing in terms of number of tests delivered and also the price per test delivered. This is a big winner because they're using this existing business and then now feeding all this data that they get in and randomizing it to comply with HIPAA laws, to then come up with insights in 2 ways. One, to help drug companies develop better drugs more efficiently, smarter, because they have all this data on patients and all the biomarkers that might help lead to better treatments. But at the same time, they're using it to guide physicians for better patient care by giving them a dashboard, essentially, that says, your patient has all these biomarkers and this condition. Here's the clinical trials that would suit them best. I mean, if you're talking about a primary care physician in the middle of nowhere, Arkansas, there's no clue. They have no way not most of them. I don't want to discriminate, but I'm going to say on average, the majority of physicians in the middle of America or at a medical research center aren't going to have awareness of these clinical trials. And that's what Tempus AI is bringing to bear, is the existing business that they've leveraged in 2 ways to generate additional revenue.
And this feels good. I mean, it's AI in healthcare and for good, so that's awesome. Not saying that, AI is not good in tech and everything else and information, but
no,
awesome.
I think that's the key point that we're going to end on that too. This Tempus AI is a feel-good AI investment where people get caught up and just think it's people doing, ChatGPT searches for cheating on tests and in college, right? So, but it's actually solving real problems.
AI is going to take my job, which we'll talk about that later too. But
it's taking your job by the end of this episode, buddy. You go get a beer. We're going to celebrate your long run here.
All right, sounds good.
All right,
there we go.
With that being said, we got to remind everyone to make sure you're following us on socials. In fact, last break we told you to follow us on YouTube, but head on over to X and follow us there as well. Elon Musk says you should do it. Well, if he knew me and followed me, he would. But I share a lot of insights on X. So on YouTube, we're getting all the latest episodes and some interviews. But if you just need more insights in terms of what's going on in the market, what things I'm focused on, and how it impacts the key trends we always cover here on The Big Skinny, follow us on X, and you'll be right up to speed every market day that we're at it. So with that being said, we're going to be right back with our guest, the COO of Public.com, right after this quick break.
There is no reason on planet Earth that these people need to own individual securities, including futures and options, and trade them.
100% agree with you unequivocally. Congress members should not be the best performing investors on Wall Street. Do we outright ban it? I don't know, but here's what I can tell you. I'm on the board of 2 public companies. I work for a public company. I was an investment banker at a broker-dealer. There are so many strict regulations and well-worn regulations about timing investments and when it's allowed and when it's not allowed. They have definitive access to material non-public information. It's a no ifs, ands, or buts about it. You shouldn't be allowed to trade on that.
So I have never owned individual securities, and I've worked in financial journalism for over 30 years. And quite frankly, you will, in mutual funds and ETFs, beat people who pick individual stocks anyway.
I take issue with his first point, though, because the rank and file in publicly traded companies absolutely have more context than the average investor on Main Street. There's a definitive advantage that they have being in Congress and knowing what's being considered and hearing conversations. Does it cross and breach the level of materiality as defined by FINRA? I don't know, but I think it's pretty slippery slope to say that they don't have an advantage by being in those conversations. All right, welcome back to The Big Skinny with me, Lou Basenese. This is a time of our show where we live out one of our key beliefs in our manifesto, to be humble or be humbled. We know there's just not everything, it's not possible for us to know everything well, and that's when we bring on industry experts and people and innovators that are doing things that are far beyond our level of comprehension. And with us this week is none other than Stephen Sikes, the CEO of Public.com. Stephen, welcome to The Big Skinny, my friend.
I don't know if it warrants an applause, but
hey man, in our studios it does. You got the fans here that you might not even be aware of. Listen, I want to start with the end in mind, and then we'll kind of backtrack and fill in details. But Public came out with a recent announcement where basically AI is reimagining the investor, trading account. Can you tell us about what's going on?
Yeah, I mean, I think since the original launch of really GPT-3 in API form, so we're talking before ChatGPT started. Like, we're going back to like early 2022. We've been experimenting with AI tools.
I love, wait, you said early 2022, like it was like 30 years ago, but in AI years, that is 30 years ago. So
doesn't it feel like it, right?
Yeah.
I mean, it honestly does, right? I think in both AI and markets terms, that was a different generation, a different world. But anyway, so we were starting to experiment then, right? And we started to kind of use AI throughout all of the relevant surfaces that we have in the public platform to create a better investor experience and help create, really serious investors, help them be better at researching, make better decisions, and ultimately have better outcomes. And
how many investors were there on the platform at that time? Just to give some context.
I mean, listen, I think we grew a lot sort of in the, in the COVID and then GameStop era. We were in the millions then and continue to be in the millions now, right? It's nice. One of those things, you get to a level and you really achieve pretty significant scale. But yeah, so I think it started with, helping people research and keep track of what's going on in their portfolio. The first product was a tool called Alpha, right? Which again was a great way to really understand what's going on in the markets. That Alpha product helped us build like, why is it moving? Which is one of my favorite features, which, everyone opens up their app every day, looks at their portfolio and says, okay, here's how I'm doing overall. And then they want to know why, right? And they want to look at which positions are going up or down. They're going to drill into the one that's up or down and say, why is that one moving? And AI is phenomenal at synthesizing that information, and we did that with Alpha.
Where are the sources that it's pulling from that? I mean, is it integrating on different social media platforms, information from analysts? Like, where are all the inputs to tell you what's going on?
Yeah, so it's a bunch of high quality news and market data sources, right? Basically everything that you could imagine having in just a broad company news feed, right? The sort of things that you would see, at the bottom of your public screen, sort of thing, again, Twitter accounts and so on. So as broad as we can, it's trying to pull a cross section of the market information that's there. And it does quite a good job of keeping on top of what's going on with an individual position.
All right. So you've rationalized research, you've rationalized like, hey, what is going on? Then also you guys are getting into like basically creating custom ETFs, if I understand this correctly, the announcement.
Yeah, so the first generation was really about research. The second was like really starting to build a good, great portfolio and building tools that help people be better investors. And that's what generated assets is, right? I think you guys were talking earlier about, top AI picks that aren't Nvidia. I think if you wanted to build a full portfolio of those and you wanted to use AI to do it and, ultimately build a big diversified, basket of stocks to look at and to follow that theme, right? Generated assets going to be the thing for you, right? It builds that portfolio. It comes up with the weightings. It gives you the rationale of, why every one of the names is in there according to the parameters of the prompt that you gave it. And then you click one button and it invests in it and manages it over time.
Wow.
It's really a tremendous feature. And it's one of those things that really helps, really serious investors build well-diversified portfolios according to their themes, and manage them over the long run.
Now, can you share those generated asset portfolios with other people, or is it just, it's completely custom?
Yeah, it's completely custom to start. We're working on the ability to share them within the platform so other people can see and build upon the work that you've done. I think there's more to come on the sort of sharing and social angle there.
Interesting. Question for you, and this is me getting into the weeds a little bit. Could I say, look, I love this ETF, the new Dan Ives ETF, but I hate the one stock that's in there. Can you build me the Dan Ives ETF minus Nvidia? Is that possible?
Yeah, I mean, I think you absolutely can. Now the question is like, where are you going to get the data from?
Right.
But yeah, it can handle that. I'd suggest you give it a try and see how it does pulling it. What it does just at the kernel of like how it works, right, is when you give it a prompt like that, it's going to say, okay, how many individual stocks am I going to need to research? Therefore, it's going to launch a bunch of different agents to go and research sort of the universe that you give it. The first thing it's going to go do is try and figure out how many stocks are in the Dan Ives ETF, and then it's going to try and find each of those individual stocks and bring it in. So right. I wouldn't say the pipeline in AI is optimized for sort of starting with an individual portfolio like that, but there are places where if you can give it the individual index and it might know what those index participants are, it can do a really good job.
And then it's just going to keep getting better as we see with Gemini being released and all these AI models continuing to evolve. So, I mean, I would say that you guys, it's built in, right? It's just going to keep upgrading in terms of its capabilities.
100%. We're going to keep developing on top of it. And, that's sort of the generated assets. I know we can also talk about sort of a full agentic brokerage approach, which is something we announced last week as well. And I think, that's where we're building towards.
Yeah, tell me about that, because I'm sitting here talking to you and I'm thinking, I came out of Morgan Stanley's private client business where I witnessed in my 20s a room, we called it the bullpen, full of financial advisor soon-to-be's just cold calling. And like, I listen to what you've built and are building and vision, and what's the purpose of a financial advisor anymore? I mean, candidly, is this the grand vision to replace a certain segment of the advisory business?
Yeah, I mean, certainly it'll help perform a function of the advisory business. And I would say that's the sort of mechanical execution, right? I think, starting from, I don't know, if you disaggregated, what do advisors do, right? You're going to start with things like, okay, they're going to, help create a plan for you to execute, right? And have and a financial plan, right? Agentic brokerage, not going to do that. The second thing it's going to do is going to help implement that plan. If you know what you want to do and you know how you want to manage your portfolio, you want to know how you want to manage your cash flow, maybe you want to take cash out, tax efficient way here or there. Agentic brokerage, perfect for the mechanics and execution, right? And then the third thing, what do advisors do? They're a little bit of emotional support. Markets go up, markets go down. You want somebody there to help manage the way that you react to that. And again, AI is not there. So again, our point of view is there's always going to be a role for advisors, especially, on that emotional support. Planning, again, continues to be sort of the realm of advisors, though I do think there's an opportunity that AI will take more of that over time. But really where we find AI and agents can add value today is once you know what you want to do, helping execute those more complicated mechanics, right? It's like managing your recurring investments, making, trigger-based decisions, deciding how to allocate cash or, shift cash between your high yield cash account, your savings account, and your brokerage account, things like that, helping sell, a particularly appreciated position smartly so you minimize the tax consequences, right? Raise cash across an overall portfolio, again, to reduce your cash exposure or your tax exposure. Yeah, like those are things where it's like, it's a function of data and the right toolkit. Agents are going to be fantastic.
Yeah, and it sounds like it gives you discipline too, right? Because people always get emotional and make the wrong decisions, and this is a forced, it's basically hiring a portfolio trainer instead of a physical trainer. Hey, we're going to make you go through the motions that are required to stay in good health, portfolio health. Is super interesting. So what else, what else do you have on the horizon, right, that you can speak about publicly, no pun intended, that you see a vision for this whole platform becoming as AI continues to evolve at a rapid pace?
Yeah, listen, I think we have a lot more to come. Again, agentic brokerage, the way I would phrase it is it's like, anything that you can do on public, any individual function that you can perform with your broker should be able to be performed through this sort of agent, right? And it should be able to combine those tasks into really interesting things. So, it could go everywhere from like building your own sort of rule-based or algorithmic trading strategy, all the way through just like making sure you can pay your bills if you want to, sort of run your household cash flow off of a margin line and you want to do that well, right? It can perform that full function. I think we're going to keep investing in making sure it can live up to sort of every one of those functions. And so it's such a generalizable tool that I wouldn't say it's like one of those things that's going to have, different, it's going to continue to get smarter and better over time. It's not necessarily us building like a net new feature on top of it.
Yeah.
One thing I would highlight is, again, I think the cool thing is all of the portfolio management tools that come on top of it. And like those start with what we call direct indexing, right? You guys, it's a familiar topic. You could start with the S&P 500. You could invest in all 500 names rather than just owning the ETF. And that helps you have more control, customization. You can, say you don't want to have Apple in there, you can remove Apple. Say you want to, reweight the Mag 7 so they're equal weighted, so you're not, arbitrarily picking among them. There's a bunch of different things you can do within direct indexing, and then you can tax loss harvest it, right? And so taking all of those tools from direct indexing, continuing to enhance those to improve sort of after tax, after fee returns, and bring those over to the agentic and generated assets side. I think a ton of really cool stuff to come there.
Yeah, and then for people that aren't familiar with Public, what can you do on the platform in terms of trading different assets, right? So crypto, do you have margin options? What's on the product roadmap to where it can be a one-stop shop for all your investing needs?
Yeah, I mean, again, that's what we've built towards, is that sort of one-stop shop idea and one-stop shop place for serious investors, people that, again, want to have the best after-tax, after-fee return in the long run. And I think that's exactly what we've built. Again, it's every asset class, that the vast majority of investors are going to want: direct access to equities, ETFs, fixed income, both corporate bonds and treasuries, direct access at low cost on your phone, unparalleled there, crypto, options, margin, retirement accounts. Again, you go through the list of all the things that, really a long-term investor or an active trader need in this market to do a really good job of managing their portfolio, and Public's got it.
And then this is the analyst brain in me is just wondering, because I think this is a genius setup, how you're moving towards the areas using AI and leveraging it for individuals to get really an edge up in tools that they don't have. Is Public, pun intended, ever considering going public? Like, what's the revenue model here in the long-term plan? Is that something that's on the roadmap potentially?
I mean, again, it's in the long, I won't say specifically, what our plans are. And again, I don't think we have timelines. We're still a private company. We enjoy being a private company and the growth and the innovation that allows us to pursue. But, again, we definitely see some of our competitors that are public companies and and recognize the benefit of having our customers, the investors who, trust Public with their assets, being able to be owners in the company. And, I think that would be a long-term aspiration for sure.
Yeah, no, look, I think there's a tremendous opportunity. There's been tons of consolidation in that space in years past, but I want to encourage everyone listening here now live or maybe recorded to check out what Public's doing. You can do that by using the QR code on the screen or going to public.com and see what the standard is for active trading all in one platform. Stephen, I want to thank you for joining the Big Skinny and invite you back soon on the next big news coming out of Public if you'd like to join, man.
Yeah, Lou, would love to come back anytime. And just for the audience, again, we make ourselves available online on Twitter, LinkedIn, Reddit, wherever you could find us. Like I said, we're pretty easy to find and always happy to talk to people that are considering Public or existing customers that just want to rap about the markets or understand more about what we offer.
Awesome. I love your willingness to field whatever questions you get. That's something that's right in line with what we do here. So thanks again, Stephen. Thanks for joining the Big Skinny. And folks, thank you for joining this latest episode. We're going to be right back after a short break.
Well, the Dow's still up 300 points, and the Nasdaq is up 230. Not bad. Lou Basenese he's got his stock picks with him, and the first one is, put it on the screen, please, Teradyne. It's down today, though.
Yeah, down a little bit, but I love chip stocks that aren't Nvidia, and Teradyne is a test and equipment maker that tests all these high-powered chips. So it's levered to AI, but they're also levered to robotics. 16% of revenue comes from robotics. This is a great pick and shovel play on all things AI, all things that have chips in them.
And AI is not a bubble, so...
It is not a bubble, so it's time to keep buying Teradyne.
Okay.
That's right.
Tell me about Lattice Semiconductor.
So another semiconductor, right? If Nvidia is the MVP player, you have to be surrounded by other supporting players, supporting chips, and that's what Lattice does. It makes chips that help the AI data centers run more appropriately, more functional. Again, it's a pick and shovel play. So the bigger the boom gets with AI, the more of these chips that you're going to need from Lattice Semiconductor.
Sounds good. All right, Luke, thank you very much.
Welcome back to the Big Skinny, where they're giving your host with somewhat of the most a little trouble here behind the scenes, because we had a comment about 533 today that said I was on point. I'll take it. I'll take the love from Shana. Ooh, you. I don't know. Yeah, I can't read today. Thank you. My wife says I was on point too, so I'll take the love from her as well. Folks, we're rolling right through this episode of the top 10 AI stocks not named Nvidia, bringing the Dodd man back for our up and coming, newly popular headlines and head scratchers segment. Are you ready for it?
I'm ready, but I do need to say first that Lou, you
forgot your sunscreen again? Hold on.
Dude, what? I think I need new lighting. I just got out of internship mode. Maybe I can afford some lighting sometime soon or something like
Listen,
that.
you live in the sunny state of Florida where they practically give away ice pops and sunscreen, man. Like, come on, it's readily available.
Well, I guess lighting isn't my forte.
I'm busting your chop. All right, headlines and head scratchers. What do we got coming at us this week that makes us maybe go, think twice about it?
Well, I think the first one is back to biology. I think
Did you ever take bio class?
Did I? It was so long ago. My son is in biology and all those classes, and I run from all that stuff. Luckily, my wife handles that stuff because it's been a long time, brother.
Hilarious.
How about you?
Yeah, no, I took way too many bio classes because I was pre-med for a period of life and took biochemistry and too many bio labs. But anyway, this headline out of Genetic Engineering and Biotechnology News, which obviously is an industry rag that is on everyone's coffee table, right? Everyone reads this. It's like Time Magazine. Yeah.
Yeah, but I've got back issues of that stacking up.
Yeah, this headline is really important. So this is one of those things that we find great investing opportunities because things fly under the radar. They start bubbling up in the industry rags before they make it to the mainstream. And here you have Jen saying biopharma embraces synthetic biology. They're applying these tools. If you remember any of the companies that were part of the synthetic biology boom that went up and then bust because they were trying to use cells, think of yeast making alcohol. They were trying to do that to make reasonable chemicals like biofuels. Failed miserably. It couldn't scale up. But now similar technologies are being applied for drug development. And the timing's actually interesting because we conducted the latest episode of The Upside, our series where we provide everyday investors access to CEOs with no spin, no fluff, no gatekeepers, just the innovation and information that matters. And we were talking with the CEO, Michael Heltzen of Exozymes, which is basically, revolutionizing synthetic biology, which they're calling biomanufacturing this time around. So it's synthetic bio 2.0, and they're actually scaling up. So we encourage you to go check out that interview at tbsupside.com at EXOZ. It's the ticker, or just scan the QR code on your screen. And Dodd, you listened to the interview. What were your takeaways from Michael?
Obviously, it was a great interview because you were on point. As always.
You got just buttering me up. Here we go.
But I think one of the things that stood out to me that was, once again, we're talking about AI, pretty much everything these days, but the fact how they're using AI to, as Michael said, it's not from a Yugo to a Porsche. It's more like a rocket ship. How they're turning things in weeks and months and quarters rather than years and decades.
Yeah, I think that's
just the speed of everything.
Exactly right. The speed at which they're using AI. And he even said it from the hiring people. He went to the team and said, we're not hiring anyone else. We're going to use AI to do 5 times the amount of work, and they're doing it. So they have a potentially upcoming deal for one of the molecules that they're scaling up, NCT, which would be basically think of it as an over-the-counter supplement that would have the similar impacts potentially to the GLP-1 drugs like Ozempic and Wegovy. So super interesting. I can't do it justice here in the time that we have left, but we can do it justice in that interview. So make sure you check it out.
I've checked it out, but make sure the viewers go check it out.
I was talking to them.
Looked like you're looking at me.
No.
Earn it.
Yeah, look, people are going to get tired of me saying this, but it's like our be humble or be humbled. Stock prices ultimately
follows earnings.
See, look, you're learning, right? I mean, it's like
I'm going to put a
parenting.
T-shirt on our swag shop that says that with your picture.
Yeah, that's right. Stock prices follow. It is. It's a fundamental truth. You don't have to get it complicated to win in investing. It's super simple. This is a different stock chart that I've seen to drive home this point, because normally it just shows the S&P 500 price and S&P 500 earnings per share, and they're moving up with each other, with the exception of the financial crisis and COVID, where they just kind of deviated temporarily. This actually tracks the earnings per share on the x-axis. So as the earnings per share go up or increase or go backwards, you see what happens to the price, and like it looks like, you know, my 17-month-old son's latest drawing, but there is, you know,
that's funny. That's what I was just thinking we were looking at.
Yeah, you know, Grayson's first, you know, chart here. That's what that GFC is. It's not the great financial crisis, but you still see there's a trend up and to the right, because as earnings continue to go up and to the right, it's not a straight line. Some quarters it's, you know, earnings are higher, some quarters they go down, but the price by and large tracks with earnings. There's no other variable related to the stock prices that's as strongly correlated, in my opinion.
Yeah, that definitely looks like I hear you, but that does look like a Grayson drawing right there.
Yeah, but here's the great thing, the takeaway, right? We just finished Q3 earnings, and S&P 500 earnings growth checked in at 10.7%. If you look at the Mag 7, it was 18.7%, and the rest of the S&P 500 was close to 8 or 9%. Man, we're cooking with gasoline. That's an awesome thing for earnings. Everyone screaming about a bear market is not paying attention to the one variable that matters.
Yeah.
So
Let's
earn it.
so.
It's coming.
Okay, mad at Meta. I'm sure,
Meta.
Sure, you know, how did you know, he zucked the world again, you know?
Zuck's off. Yeah. I'm just gonna leave it there. Look, this is probably the one company on the face of this earth, and I'm not someone that talks trash about anyone, but this is the one company I have proudly never owned. I've never been on the Facebook platform. And here's the reason. It's principles over profits is for me, right? This stock has traded on the cheap by all valuation metrics, screaming buy left and right, especially at times when it's trading for 13, 14 times earnings, and it's nothing but an advertising company where you know those ad rates are good. But Meta and Facebook, let's just call it what it is. It's Facebook. They changed their name to the metaverse and just incinerated capital. But more filings are coming out, more news reports where they were literally allowing pedophiles to reach out and use the platform to contact underage children for their just disgusting crimes against humanity. And they had a 17 times strike policy, not 3 times and you're out like we have in some of these jurisdictions, but a 17 times before they even flagged it. It's just disgusting to me. And this is just one example in a long list of where Meta puts profits over principles. You had the Cambridge Analytica scandal where they just violated privacy. Everyone on the platform, you have just internal research documents that showed the negative effects of social media, particularly on preteen girls. And here's my thing. If you knew about it, you should have said something about it. You shouldn't have covered it up and made billions of dollars in profit in the process. So yeah, I'm mad at Meta. I'll speak publicly about that.
I think the only hope we have here is, you know, in time, you know, none of my kids, and I don't think your kids probably use Facebook anymore. You know, Facebook is, I think for the most part, you know, it's all our age and, you know, folks. So hopefully
your age, you're a little bit older.
Yours too, sir.
Yeah. So here, I have a simple solution to it. It's called Revised Section 230 of the Communications Decency Act, which would make social media platforms liable for the content that goes across their platforms. With all the AI innovations, they can police all of this illegal activity. It's no different. It's like Sarbanes-Oxley for publicly traded companies, where the executives have to personally attest to the financial results and could be criminally and personally liable. Do it for social media companies. It's done. It's solved. Easy fix.
I mean, these companies are spending enough in AI. You think they could do it to, you know,
dude, Zuck's incinerated over $50 billion on his metaverse that went nowhere, right? He is still waiting for his iPhone moment to make hardware a big thing at Meta. It's never going to happen. Why not make the platform safe? Anyway, off my soapbox. I'm not going to be mad at Meta for much longer because I'm not a shareholder, but still, I think people need to open their eyes and pay attention that investing is not just about profits. You talked about it earlier. There's a double bottom line if you invest in the right companies. One's developing new drugs that cure diseases. One's helping and developing solutions that, you know, for real world problems, not connecting you with your exes from high school on a platform or just, yeah. Anyway, I digress.
All right, AI lies. Now this one's funny, not funny. You know, the idea that companies are just blaming AI for everything. It's, you know, we're firing 10,000 people because of AI.
Yeah, AI lies. Companies are lying. I think this guy that wrote this post is missing the point too. And I wanted to bring it to everyone's attention because it happened. I think we showed it in the clip with Liz Klayman. She mentioned this MIT study that said that over 95% of companies have not seen any profit or benefit yet from their AI investments. This is the most overused bearish stat, and it's like saying you started working out yesterday and today it didn't work because you didn't lose 30 pounds overnight. I mean, it's just completely misapplied. The MIT study is too premature. It's too soon to really see the impact of AI. Companies are still figuring out how to use it in their day-to-day lives. Early adopters, myself included, are still in the last 6 months going from just a very baseline first innings exposure to it to figuring out how it's really leading to productivity gains. It's going to be years from now before we really figure it out. So the net takeaway is don't believe the lie that 95% of AI investments are worthless, because it's too soon to tell. Too early.
Yeah, absolutely. All right.
I mean, do you agree?
Back.
You see it on the design side, right? I mean, you've seen AI in terms of creating, graphic design and creative design. Am I wrong?
Well, I thought my graphic design in AI was fantastic, but by the last show, your birthday episode, all proof from you said it was terrible. So I guess you answered that question. You hated everything.
Look, I would tell people, anyone that's involved in this industry, I have a good friend that is a design build architect where he literally writes sketches of, hey, this is the kind of building I want, and it can build full plans from that sketch. He's like, it's totally changed his workflow. So to be
I think
continued.
it's getting a lot better.
Yeah,
it's getting a lot better. But to your point, for the normal average individual, it's still not something you just like go to a website and just type in some words and it works. I mean, prompting and how to use it, and all the agents, and there's still a complexity behind it that's going to take a long time for mass adoption to actually impact, like you're saying, I think.
Yeah, totally agree. I mean, I'll give another analogy that I think sums it up perfectly. Back in 2008, when Apple launched its first smartphone, right, no one really thought it was going to be that big of a deal. They dismissed it. It wasn't going to change the game. And then now look how many people are connected to this device and their iPad, right? So I think AI is going to be similar. It's going to be seamless, and it's not going to happen overnight. That's the key.
Yeah, it's going to be a while, but it's not going away, and there's no bubble.
No.
All right. Bounce backs.
Yeah, here's the thing. I don't want people to think I'm always a glass half full kind of guy, which I am, but I am reasonable, right? I do want to bring up concerns that people have. There's fears of a bear market, and I think it's right, as we had with Stephen Sikes when he was talking about that place that financial advisors will always play in terms of handholding and emotional support. I think everyone starts to get afraid that we could have a nasty bear market. The reality is, when we get bear markets and not recessions, this chart shows the number of months to recover to new all-time highs after a 20% pullback. By and large, it's really quick. I mean, we had one of the quickest months back to new highs after this year alone. We had a 20% pullback after that tariff tantrum back in April. So I think the takeaway here, if we had a second investment insight of the episode, is it's not about always getting it right. It's about always staying invested, because you just don't know how long the downturn is going to last. And if you have a broadly diversified portfolio, not all your money tied up in 1 or 3 stocks, you're going to weather that storm. And I think that's what's key here.
And I think it's important not to, have the get rich quick attitude, especially nowadays with the AI energy stocks and all the hype and stuff that's there. There's fundamentals there, but even, as Mike Alfred always says, it's, you got to go long, and you got to endure some of those ups and downs that are going to happen. So,
yeah.
And then, just Stephen with public, it's kind of saying there's tools now that you can use to really be smart about it and invest, wide and broad and, and deep. So.
Yeah, along those lines, I'll encourage people, if you do nothing else today, read one article. It was written, maybe 10 years ago by Morgan Housel. It's called The Agony of High Returns. He wrote for The Motley Fool, so it's easy to digest. And his point was the best performing stock of all time prior to probably Nvidia was Monster Beverage, believe it or not. And it was up at this time of him penning the article about 10,600%. And he went back and said, everyone wants to believe that they could hold on to the Monster Beverage, right? If they just knew about it in advance. And he's like, you're crazy. Next to none of us had the conviction, because he went back and looked at the history. And I think Monster Beverage, on its rise to 10,600%, went through 7 or 8 corrections of 60% or more. So imagine you see that thing run up, 400 or 500% and then pull back 60%, and then run up another 300% and then pull back 60%. So that volatility, to your point, just comes with the territory of long-term investing. And I think it's important for people to realize, don't get scared stockless, because that's the worst place to be.
You'd have to be a unique individual to be the one that held on to Monster Beverage through all those ups and downs.
Yeah, there's unicorns. They exist. I used to have a client who held on to a company called Medivation from less than $1 per share, and it was trading at like $100 million market cap, and then it got bought for $14 billion. All right, Chad, rounding out this episode with some insights on the reason for AI layoffs, in my opinion, is because of the cost of chips and the need to get gobbling them up. Look, here's what I would keep gobbling them up. Here's what I would tell you. S&P 500 profit margins are near record territory. I think we just jumped above 13%. So there's plenty of margin there. I just think these companies are using the AI umbrella to just lay off middle performers. We see this. It's mostly been in tech. We saw this back in 2022 and in the beginning of 2023. Big tech during their boom days overhire, and then they have to cut out the middle. I mean, Amazon's getting rid of engineers. I mean, it's just part of the process. But we'll have new jobs and new job creation that comes with every technology boom, just like the last time, right? We didn't have hundreds of thousands of people, millions of people out of work after the dot-com bubble collapse, right? They found employment elsewhere. I think these people will find employment elsewhere too. And if you're one of those individuals, individually, I'm not trying to minimize it. I know the impact is real, but I would tell you on the optimistic side, there's going to be a lot of innovations that make it possible for more jobs. Another solid show as we round out. Chad, thank you as always for joining and chiming in, and thank you all for listening. Once again, episode 30, is it 31 in the book? 31, man. We are just aging quickly, my friend. Well, thank you as always, Dodd. Thank you to the crew here in the studio as well, and thank you to all our loyal listeners for joining us. Tune back in next Monday, 5 p.m. Eastern for the Big Skinny Live. I'm Lou Basenese, signing off.